Hello friends, good morning to all of you, and this is the next video for the module D of BFM, and we have been covering the chapter number 4 related to liquidity risk management, and this is the second part related to this video. So do confirm the audio video quality at the earliest so that we can proceed. So we have already covered the three modules A, B, and C, and I hope that you must have been liking the videos. And thank you so much for showcasing your love. And do subscribe the channel if you have not subscribed the channel so far, and press the bell notification icon so that you get updated whenever we upload the new videos. So the complete course, the CAIIB crash course is available. You just simply need to WhatsApp me writing CAIIB to the number 83609 and I'll be sharing all the details with you. So the audio video quality is working all fine. So let's start the session here. So first thing first, it's about the liquidity risk management in the banks. I've already told you we have already covered the different things related to it. The last topic we covered, it was related to that there should be specific policies for the management purposes for the liquidity risk management, right? And now it's about the role of the business units. So all the business units which are conducting the activities that may affect the liquidity, those must be fully be understanding the bank's liquidity strategy. So every single business unit which may impact the liquidity, right? They should be understanding the bank's liquidity strategy. They should be operating within the approved liquidity policies, like whatsoever the liquidity policies are there, or let's say the procedures are there, they should be following that, and they should be ensuring that their activities do not create excessive liquidity pressures, right? So they should also be taking care of it, and at the same time they should be providing the timely information for the liquidity monitoring to the board of directors or to the higher management, right? After that, it's about the role of the board of directors. Role of the board of directors. So the overall responsibility, like related to the any type of risk that lies with whom? That lies with the board of directors, right? And the board is having the responsibility so as to monitor the performance. They need to review the liquidity position. They need to look into the risk profile, and that should be done periodically. And also, they should be reviewing the liquidity risk. They should be assessing the liquidity risk in the key portfolios. So whatsoever the key information, the information is available, they should be reviewing it, and whatsoever the key information is there, they should be reviewing it also. And information must be like the information must be available timely, it should be accurate, and it should be sufficient. And they are also to prove the strategy, like the board of directors are to approve the strategy related to the liquidity. They are basically to draft the, they have to basically approve the policies, they are to approve the tolerance limits and the overall limits, right? So that is the role of the board of directors. Then after that, it's related to the liquidity management structure. So bank should be having a clear structure. So when we are talking about the bank, so about the liquidity management, there should be a clear structure about it, how the liquidity strategy is to be implemented effectively, right? And the responsibility for the overall liquidity management, that should be assigned to a specific identified group. Like it should be either be assigned to the ALM, that is a asset liability, not ALM, that's defined, either be given to the ALCO, that is a asset liability committee, that's a senior level committee for the liquidity and the ALM decisions, right? So specifically, a particular identified group should be there to whom the responsibility should be assigned, right? Or it could be the treasury department. So either it could be the ALCO or it could be the treasury department, right? Or it could be the RMD, that is a risk management department, right? So under the ALCO, we are having the senior level committee for the liquidity and the ALM decisions. Under the treasury departments, under the treasury department, that basically manages the day-to-day liquidity and the funding, and like the CRR balances are to be maintained and everything. And if we are talking about the RMD, like it's about monitoring the liquidity risk, limit, stress testing, reporting, those are being done by the RMD, right? So overall responsibility must be assigned specifically to the identified group, like I told you. So it can be assigned to the ALCO or to the RMD or to the treasury function, right? Then it's related to treatment of the foreign currencies. Like the banks who are basically dealing internationally, liquidity management is much more complex for them because they have to manage the assets and liabilities in the multiple currencies. They have to manage in multiple currencies. So, what are the major reasons for the complexity? Why the complexity is there? First of all, the banks may be less known to liability holders in foreign currency markets, like the liability to the liability holders. They must be not be that much known. That can be the scenario. Like in foreign country, you are not that much known to the depositors. You are having a very limited space over there, and it could be the case like that domestic liquidity may not always be usable. Domestic liquidity may not always be usable for foreign currency funding needs. Like you cannot be using the domestic currency for the foreign currency funding needs. Okay, so that's also the one of the reasons related to why there is complexity. So as to manage the liquidity for the banks who are having the international operations. And sometimes what happens that the currency swaps are not available, foreign exchange markets are very much, let's say, under crisis or something, or it could be some currency specific liquidity risk also. Let's say you are having the surplus liquidity in one currency, and that's not going to solve the shortage in the other currency. So these are also the reasons that why the liquidity risk management in cross currency is quite complex. Okay, so the bank is to conduct and the bank is to take decisions for the multi-currency liquidity management. And what are the two key decisions into it? Let's have a look at it. The first thing, it's related to that there should be a fully centralized approach. So there should be a centralized approach for the same. Like head office is managing the liquidity for the entire bank for all the currencies. That can be the case. And also there can be the decentralized approach. Like operating divisions, they do manage their own liquidity. Like there are operating divisions which are going to manage their own liquidity. So one case it's related to the centralized, and the other one it's related to the decentralized. So we can be centralizing it that everything is being managed by the head office, and it could be decentralized like the operating divisions are managing their own liquidity, and they are basically provided the limits from the head office, and they are to report to the head office. Or it could be third approach also, that is a hybrid one. So we can say there can be a third approach also, which will be saying to be the hybrid one. Now, under the hybrid one, the head office will be managing the home currency, and the overall coordination will be done by the head office. But the foreign offices will be managing their own currencies. Like the foreign offices will be managing their own currencies. That's the first decision we have to take, right? So the first decision is basically related to the management structure, that who is going to manage the currency structure. The one, it is the fully centralized or the decentralized or the hybrid approach. And the second decision that is to be taken, the second decision that is to be taken, that is related to currency wise liquidity strategy. Currency wise liquidity strategy is to be taken care of, right? Now, here are some questions that should be taken care of, right? How will the foreign currency funding needs will be met? Like from where will be getting the foreign currency? From the deposits, or we are to borrow the funds, or we'll be using the swap or interbank market, whatever it is. Like, so first of all, we have to answer this particular question. We have to answer this question. The second question lies in that to what extent will a bank fund foreign currency need in domestic currency? Like bank may be raising the domestic funds and then can be converting into the foreign funds. To what extent the bank is able to do that, and the bank wants to do that, right? And how the swap or foreign exchange risk will be managed. Now, if you're basically able to swap the currency, then you'll be having the swap risk also, you'll be having the foreign exchange risk also. How that will be managed? Like if the bank is swapping the currency, now how the bank is going to manage that particular risk, and what is the backup plan? What is a backup plan? Like what if the exchange market cease to be available, if the foreign currency is not available from there? So then what is the backup plan? The bank must be maintaining some alternate funding arrangement also. So the decision related to this, so the first question was related to what, that from where we'll be meeting up our currency needs, first of all from foreign currency needs, and the other one, up to what extent we are ready that we will be converting the domestic currency into the foreign currency. And if we are going to use a swaps or something else, like how we are going to manage the foreign exchange risk. And the fourth one, it's related to what is a backup plan for us. What is our backup plan? Like alternate funding arrangement, what it will be, right? So that's the case. Clear with it? So this is how we have to take care of it. Okay. Now, as I told you that the bank must be having a backup liquidity strategy. The bank should be having a backup liquidity strategy. That's a contingency plan the bank should be having. Wherein normal foreign currency, let's say funding is disrupted in that scenario. So the bank should be maintaining the currency liquidity assets. Like in foreign currency, you can be having the liquid assets so that if you're having any urgent obligation, you can be meeting up that. You can be having the committed credit lines. So it could be like that we can be having the committed credit lines, right? We can be having the we can be maintaining the foreign currency liquid assets, or we can be doing the currency wise stress testing so as to evaluate that liquidity, what liquidity gap is there. Okay, so these things can be done. Then after that, it's about the setting the tolerance levels and the limits for liquidity risk. That we are to set up the tolerance levels, right? So bank management must be setting up the liquidity limits, and those are to be reviewed by the supervisors. So definitely the limit should be there, but those are to be reviewed by the supervisors. The first thing first, it's about the cumulative cash flow mismatches. Now, what is the purpose of cumulative cash flow mismatches? Like it's going to measure the cumulative net funding requirement as a percentage of the total liability. Let's say your total liability is 1000 crore, right? And what is the mismatch? Like in what amount, particularly as compared to that of the total liability? Let's say 5% of the cumulative cash flow mismatch is there. Then we'll be looking at like those 50 crore only, right? So that's how it works. So cumulative cash flow mismatches is basically measures the cumulative net funding requirement, right? The second thing, it's related to liquid assets as percentage of the short-term liabilities. Liquid assets to short-term liabilities ratio. So it's going to ensure that you are having the sufficient highly liquid assets. You're having the sufficient highly liquid assets against the short-term obligations. Against the short-term obligations, you're having the highly liquid assets with you. The third one, it's related to the loan to deposit ratio is to be looked into, because the bank is to set the tolerance levels. The first one was related to the cumulative cash flow mismatch limit. The second one was the liquid asset to the short term liabilities ratio, which is going to ensure that sufficient highly liquid assets are available against the short term obligation. The third one is the loan to deposit ratio. Like it controls excessive lending. Let me write over here. It controls excessive lending compared to the deposit base, right? So it works in that way. And for the loan to capital ratio, like whatever our own funds and whatsoever the lending that we are doing is not excessive compared to that of the capital strength, right? So it's going to work in that way. And for the fifth one, it's about the funding needs, that we be anticipated needs and the available sources. Definitely we should be having the exposure related to it. Like what are our anticipated needs, that what amount that we may be requiring, and further what are the funds sources which are available to us, like expected fund needs and how they are backed by the available funding sources. And further, the sixth one, it's about the primary sources, the primary source from where the funds will come, which are going to meet up your funding needs, like the main sources of funds which are going to provide you the liquidity support, right? And further, it's about the flexible limits on percentage of reliance on particular liability category. That on there should be a flexible limit. Like let's say the certificate of deposits should not be exceeding a specific percentage of the total liabilities, right? So flexible limit should be there. Let's say you are saying that you are going to take the funds, or you are relying on the demand deposits, but a fixed percentage that you're not to basically be relied upon one particular component much more part, right? That's the thing related to it. Further, there's a limit about that. That's the seventh limit. And the eighth limit, it's related to that the limit on individual customers. Like it is telling you about the concentration. So it's somewhat so as to avoid the concentration risk. So why we do not want to be dependent upon the individual customers? Because we want to avoid the concentration risks. We want to avoid the concentration risks. And for the ninth one, it's about the minimum or maximum average maturity. Minimum or maximum average maturity that's going to control the maturity mismatch risk. Like what is the minimum maturity that you're going to take? What is the maximum average maturity that you are to take? Right? Like the average maturity, maximum average maturity that we are working into. So it's going to control the overall maturity mismatches. And the last one is about the minimum liquidity provision. Minimum liquidity provision. That's basically going to ensure that the banks can sustain the operations during the normal as well as during the stress conditions. Clear with it? Do confirm if you're able to understand these points, because these are very much important points. So you guys should be paying attention toward it. So these are the 10 limits and these are quite important. Let me just recall them all. The first one, it's about the cumulative cash flow mismatch. Like the net funding requirement would be telling you as a percentage of the total liabilities. Then further liquid assets to short-term liabilities ratio. Like you are having the highly liquid assets against the short-term obligations. Highly liquid assets against the short-term obligations. That is it. The third one, it's related to loan to deposit ratio, so as to control the excessive lending as compared to that of the deposits. Loan to capital ratio, so as to control the lending as compared to that of the capital strength. And a general limit related to anticipated funding, like what are your anticipated fundings, and further what are your requirements about that. Primary sources, the main sources from where you'll be getting the liquidity. The flexible limits related to that you are not dependent upon one particular instrument. And further, like we want to reduce the concentration risk, so we want to avoid our limitation over the individual customers. And further, flexible limits related to the minimum or maximum average, like maturity, so that we can be avoiding the particular maturity mismatch risk, right? And the minimum liquidity provision, like the so as to ensure that the bank can sustain the operations during normal as well as during the stress conditions. Clear with it? So that is all about it. That is all about that particular thing. Now, the next topic is again very much important. It's about measuring and managing the liquidity risk. It's about how we are going to manage and how we are going to measure the liquidity risk. So it can be done through the two approaches. Like one approach is the stock approach, the other one it is a flow approach. When we are to manage the liquidity risk, it's the stock approach and the flow approach. In case of stock approach, the balance sheet position is basically looked at a specific point in time. In case of stock approach, we look at the balance sheet position, right? And in case of the flow approach, we basically look at the cash inflows and the cash outflows. Cash inflows and cash outflows in case of the flow approach. Clear with it? So the first thing first, it's about the stock approach. Like I told you that stock approach is going to evaluate what? It's going to evaluate the liquidity based on the composition and the structure of the assets and liabilities and the off balance sheet exposures. So you're having the level of the assets and liabilities and the off balance sheet exposures. Based upon this, based upon the composition and the structure of these assets, these liabilities, structure of the assets, liabilities, and the off balance sheet exposures, right, on some particular date, you're going to evaluate the liquidity. We are going to evaluate the liquidity, and there are key liquidity ratios under the stock approach, and there are almost like 10 ratios related to it. The first one, it is a core deposit to the asset total assets. The first one, it is the core deposit to the total assets. So what do you mean by the core deposits? Anyone, any idea what are the core deposits? So whenever we are talking about the core deposits to the total assets, We know the formula is quite simple. That is core deposits divided by the total assets. That's the ratio that we have to calculate. But what are the core deposits? So core deposits are the stable long-term funds. These are stable, but the long-term funds that the customers are going to deposit with the bank. And there is very much less probability for the immediate withdrawal related to these funds, like the saving accounts, current accounts, right? Small time deposits. These are the core deposits. These are stable enough. And these are low cost funds which are available to the bank. So higher is the ratio, better it is. So let me just write. So higher is better for this particular ratio. The next ratio, it's about the net loans to the total deposits that we say to be NLTD. NLTD, net loans to the total deposits. This is going to measure the proportion of deposits utilized for lending after adjusting for provisions. So the portion of deposit that is utilized for the lending purposes, right? After adjusting for the provisions. And if we are having the higher ratio, it means we are doing aggressive lending, right? It means we are doing the aggressive lending because loans are not that much liquid, right? So higher is avoidable. We do not want this ratio to be higher one. So net loans means loans that we have sanctioned from the total deposits after adjusting the provisions. So higher is not better because higher this ratio means that you are doing the aggressive lending, and when you are having the more loans, those are not that much liquid. Those are not going to be the that much liquid part. Clear with it? The next is, it is about the time deposits to the total deposits. Time deposit means we are talking about the like fixed or term deposits, right? So we are to take a look at the proportion of the total deposits that held as fixed or the term deposits, right? So that's about the time deposit to the total deposits. And definitely when we are having the fixed deposits, those are not that much liquid. Those are not that much liquid. So higher this ratio means that we are highly relying upon the term deposits. And the term deposits are what? Term deposits are the costly one. The term deposits are the costly one. So higher ratio, this ratio indicates that higher cost of funds is there. Stable funding is there because of the long tenure, and further volatility is very less. Volatility is going to be very much lesser in this case. So we want this type of ratio to be higher because these are very much stable. So higher is better in that way, but the cost is also more in this ratio. Okay. The fourth one, it's about the volatile liabilities to the total assets. Now, what are the volatile liabilities? Which one we say to be the volatile liabilities? Like the volatile liabilities, we say like we are having the bulk deposits. Let's say you're having more than 2 crore of the deposits from some institution, or let's say the interbank borrowing or call or notice money or certificate of deposits. These are what? These are the volatile liabilities. These are the volatile liabilities. So this ratio is going to measure that up to what extent the bank's total assets are funded by unstable or short-term liabilities. So more the ratio, more riskier it is. So higher this ratio means that we are relying upon the unstable funding. We are relying upon the unstable funding, and that's why we want to be this ratio to be lower. So we say that lower is better. So lower this ratio is, better it is. Further, after that, it's about the ratio of short-term liabilities to the liquid assets. Short-term liabilities means what? The short-term obligations that we are to pay. Short-term obligations we are to pay. So it's kind of the bank's ability so as to meet its short-term obligations using the highly liquid assets. So let's say you're having the immediate obligation so as to pay rupees 10,000. and you are having rupees 20,000 available with you. So the payment that we have to make, that is indicating the short-term liability. So it's like the short-term liability is 10,000, and the amount that we are having readily to pay, we are having the cash of 20,000. It is uh, basically in the denominator. So we can say the lower this ratio is, better it is. So we can simply be saying the lower this ratio means better it is. If this ratio is higher, it means the numerator will be on the higher side. Numerator is short-term liability. So the liabilities are more and the liquid assets are less. That is not a good thing. So lower is better. So we can say this ratio is lower is better. Further after that, it's related to liquid assets to the total assets. Liquid assets. That what portion of the total assets are the liquid one, like related to proportion of the bank's total assets which are held in the highly liquid form. We are talking about it. So liquid assets are like that. Let's say we have the cash in hand, or let's say the cash with the Reserve Bank of India, or the balance with the Reserve Bank of India, or call money, short money, government securities. We say this to be the liquid assets. So definitely higher the ratio is, better it is. But if you're having much more liquid assets, much more liquid asset, it means you're having the lower profitability, because if you're not investing it for the longer duration, then definitely you won't be that much profitable also. But still, from the liquidity point of view, we can say the higher the ratio is, better it is. Higher the ratio is, better it is. Further, the ratio of short-term liabilities to the total assets. The short-term liabilities, the lower the ratio is, better it is, or better higher the ratio, better it is. Lower ratio is desirable because we do not want the short-term liabilities much more to be there, right? So it's kind of the part at the proportion of the total assets funded by the short-term obligations. The proportion of the total assets funded by the short-term obligations, like you are having the demand deposits, short-term borrowing, interbank liabilities, or the current liabilities which are payable in 1 year, right? Those are your short-term liabilities that indicate your short-term liabilities, and we do not want our short-term liabilities to exceed, right? So we do not basically want this ratio to be higher. So lower the ratio is better. So lower the ratio is better one. Then after that, it's about the ratio of prime assets to the total assets. Now, what are the prime assets? Total assets we do know, but what are the prime assets? Like you're having the cash in hand, balance with Reserve Bank of India, balance with the other banks. All right, these are immediate liquidity assets. Prime asset means what? Immediate liquid assets. These are your level one liquidity assets. Okay. So we can simply be interpreting strong. This ratio is means you're having the most liquid assets with you. So higher this ratio is, better it is. So higher the ratio, the better one it is, right? And the last one, it's about the market liabilities to the total assets. Market liabilities. Definitely we want the lesser market liabilities, because market liabilities are indicating the payables that we are to pay in the market. That the amount which is payable, like the interbank borrowing, certificate of deposit, market borrowing, like repos, bonds, ventures, which are issued by the banks. Those are the market pay liabilities. And definitely, if this ratio is higher, it means that we are highly depending upon the market funding, and the increased risk would be there. So strong reliance, if this is lower one, it means that we are strongly relying upon the stable deposits. So lower the ratio is, better it is, right? So this is about the most important ratios under the stock approach. So when we are talking about the stock approach, these 10 ratios are available over here. These 10 ratios are available over here. Clear with it? The next approach that we are going to follow, it's about the flow approach. So flow approach is going to focus upon what? It's going to focus upon, like, we are to analyze the timing mismatches between the cash inflow and cash outflow. So we'll be looking into timing mismatches related to the cash inflow and the cash outflow, right? And there are three dimensions of the flow approach. There are three dimensions. What are these three dimensions? The first one is related to, so as to measure and manage the net funding requirement. Measure and manage the net funding requirement. The second one is related to managing the market assess. The third one is related to the contingency planning. The third one it's about the contingency planning. So when we are talking about measuring and managing the net funding requirement, we have to first of all do the cash flow analysis. So in the first dimension, we are to do the cash flow analysis. Now it means what? That we are to identify the cash inflows and outflows across the different time buckets. Like we can be having the different time buckets, regulatory buckets like next day, 2 to 7 days, 8 to 14 days, 15 to 30 days, 1 to 2 months, etc. These are the different time buckets. So we are to do the proper cash flow analysis that under the different time buckets, what are the cash inflows and what are the cash outflows. The second thing that we are to do is related to the maturity gap analysis. Maturity gap analysis is to be done. Now, what is maturity gap analysis? Like, what is the mismatch between the assets and the liabilities under the different time buckets? We have to look into it. And also, we have to do the cumulative gap monitoring. The third one, it's about the cumulative gap monitoring. Now, we have to ensure that the gaps must be remaining in the prescribed limit. So these are the three parts related to measuring and managing the net funding requirements. So there are three parts. Cash flow analysis, like we should be knowing that what are the cash inflows and outflows over the different time buckets. Maturity gap analysis, like what is the mismatch between the assets and liabilities, right? And the third one is related to cumulative gap monitoring, means we should be ensuring the gaps within the prescribed limit. Okay, that's related to the first one. The second one, it's about the managing the market assess. So managing the market assess, first of all, there should be diversification, that the funds should be diversified. The funds should be diversified. And further, there should be multiple funding sources. Like that's a part of the diversification itself, but multiple funding sources should be there. And the bank should be having the strong reputation. So it's about the reputation. Strong market reputation should be there. And we are to monitor the cost of funds also. We are to monitor the cost of funds here, right? So this is related to managing the market assess. And what about the contingency planning? So we should be having a contingency funding plan. The first thing, it's about the CFP. Contingency funding plan should be there. Predefined plan for the liquidity stress conditions. And also the stress scenarios must be looked into. We should be looking into the stress scenarios. We should be having the backup liquidity. The early warning indicators must be looked into. Early warning indicators. Those must be looked into, right? So that is to be done. So that is to be done, right? So I just give you the idea related to that what is covered under the flow approach. What is all covered under the flow approach. Clear with it? Now let's have a look at these all the points. So first one, it's related to the measuring and managing the net funding requirements, as I just told you. So there were the different aspects related to managing that particular part. The first one, it was related to the cash flow analysis. Then we did the maturity gap analysis. Then further the cumulative gap monitoring was done under the first thing. So this is the first part related to it. It's measuring and managing the net funding requirements. right? So flow approach method is primarily method. This is a primary method which is used by the Indian banks for the liquidity management, and this is also known as the gap method. We also say this flow approach method to be the gap method. So we are to prepare the structural liquidity gap report. Means what? That we should be having the different time horizons, and across the different time buckets, we should be looking at the cash inflows and cash outflows. And based upon that, we should be looking at the residual maturities of the assets and liabilities, and we should be looking for the cash flow estimations. And further, we'll be calculating the gaps based upon that, and we'll be accumulating the gaps across the different buckets across the different buckets. So that is to be looked into. I've already explained this thing to you. So we are having the different time buckets, like we are having the next day bucket, or let's say 2 to 7 days, or 8 to 14 days, 15 to 30 days, etc. So we are having the different time buckets, right? So we are to prepare, first of all, we are to prepare the assess and that cash in, what are the cash inflows and what are the cash outflows over the different time buckets, right? And then the assets and the liabilities should be classified based on the remaining maturity, like, and behave, and based upon the behavior patterns of the deposits, we should be looking into the gaps, right? And the cumulative gaps are to be calculated. And there is a, like, when we're talking about the gap could either be positive or gap could be negative. So we say the gap to be negative when the outflows are greater than the inflows, right? And we say the gap to be positive and inflows are greater than the outflows. So inflows are greater than outflows means the surplus liquidity is there, and outflows are greater than the inflows means liquidity shortage is there, means the liquidity shortage is there, right? So if the gap is negative, if the gap is negative, then the bank is to arrange the funds. In that scenario, the bank is to manage the shortfall. The bank is to arrange the funds, like the bank can do the interbank borrowing, or the bank can be selling of the assets, or bank can avail the central bank or the facility from the Reserve Bank of India, or from the contingency funding sources, whatsoever it is, but the bank is to manage that, right? So that's the case. The second part was related to analysis of the net funding requirements. Analysis of the net funding record, that whatever your net funding is, we are to do the analysis of the same. So the maturity ladder is basically constructed. The future cash flows are estimated. Then we are to calculate the cumulative surplus or cumulative deficit, right? So what are the key components of this analysis? First of all, it's related to the future cash flow analysis is to be done. The future cash flow analysis. The future cash flow analysis is to be done. Like based on whatsoever the expected cash inflows and outflows are there, we are to do the analysis. We are to basically look at the behavioral assumption that there could be the prepayment of loans, there could be the premature withdrawals, and also we should be looking into the off balance sheet impact. Like doing that sort of thing, that when we are looking at the future cash flow analysis, we are to look at the different points. Like some of the assumptions are to be taken care of. Some of the assumptions are to be taken care of, and we have to look at the impact also, like the off balance sheet impact, like guarantees, letter of rates are also there, right? Then we'll be looking at the cumulative position. And under the net funding requirements or net funding analysis, we can say there are four pillars into it. There are four pillars. What are those four pillars? The first one is a maturity ladder, then alternative scenarios, measuring liquidity over the chosen time frame, and assumptions in used in the determining the cash flows. The first one is about the maturity ladder, and this is a core tool when we are to do the liquidity assessment, right? So we are having the different components like cash inflows and cash outflows. Cash inflows like maturing assets we are talking about, right? So in case of the cash inflows, we are talking about the maturing assets. Assets like you have basically sanctioned loans. If the loan repayments are there, that is cash inflow, right? Maturing investment, that is basically cash inflow. On the other hand, cash outflow means maturing liabilities. Maturing liabilities. Like let's say one FDR is getting mature, you have to pay that amount. Maturing deposits, borrowings, contingent liabilities, those are your cash outflows. Those are our cash outflows. So under the maturity ladder, we'll be having a time bucket. Like we'll be like doing something. We have the time bucket like day one, and under day one, what is the position of the cash inflows and what is the position of the cash outflows, and then it will be the column related to gap. So one column is related to cash inflow, the one it is cash outflow, the third one it is related to gap, right? And also we'll be looking at the cumulative gap. Cumulative gap. Okay. So these are the different columns under the maturity ladder. Something like this. So you're having the different positions over here. Like the cash inflows you are looking at, the cash outflows we are looking at, and we are looking at the excess amount or the shortfall amount. So this is about the maturity ladder. The next one, it's about the alternative scenarios. It's about the alternative scenarios. Like the bank is to evaluate the liquidity under the different stress situations. So either it could be the normal scenario, like normal scenarios we are talking about, or it could be the bank specific crisis like loss of confidence, or let's say deposit withdrawals or rating is downgrade, or it could be the general market crisis like market wide stress is there when there is liquidity crunch in the financial market. When there is liquidity crunch in the financial market, so these are the cases. So these are the three different scenarios in connection with the management of liquidity. Normal scenarios like business as usual conditions, normal conditions. General market condition means normal. Bank specific means when people have issues related to some specific bank. And when market wide, it means liquidity crunch in the complete market. Okay. So when we're talking about this particular part, general market conditions, it's related to normal business conditions, normal balance sheet conditions, normal cash inflows, outflows, like during the ordinary course of the business. And bank specific crisis means the worst case benchmark for some specific bank. And the general market crisis when the liquidity is affecting all the banks in one or on the more markets, right? So that's the case. So that's about the three scenarios in connection with the bank. After that, it's related to measuring liquidity over the chosen time frame. Measuring the liquidity over the chosen time frame. So do confirm first of all that if you have understood the part so far, that if you have understood the concepts so far, right? So when we're talking about measuring the liquidity over the chosen time frame, it means like that liquidity position is to be assessed by what? That how we can be assessing our liquidity. Let's say in the normal term, if we're talking about as of a person, so you are having a salary of 30,000, those are your cash inflows. Those are your cash inflows. Now you'll be looking at that what expenses are to be made. You have to pay rent. You'll be looking into when it is due. You have to pay the let's say LIC policy mode. You'll be looking at what time horizon it will be due, because the rent will be due at each and every month, right? And let's say for grocery, those are to be paid for on daily basis, right? But the LIC installment is to be paid, let's say, on yearly basis. So you are looking at the different time horizons, and based upon that, you can be managing your liquidity. So this is the same concept over here. So whenever the liquidity is to be managed, right? Liquidity position is to be assessed. So we do assess the cumulative cash inflows and cumulative cash outflows over the selected time horizons over there, right? So what is cumulative cash flow? That's basically the net position. Like you will be looking at the aggregate inflows and aggregate outflows over the time horizons, over the different time buckets, and you'll be looking at the net position of the same. You'll be looking at the net position of the same. Like, let me just give you an idea. It's just like that you're having the 1 day time bucket, and the cash inflows was 300 and the cash outflows were 290, right? So these are cash inflows, these are cash outflows. The particular cumulative position, or let's say gap we are talking about here, is plus 10, right? That because that's a positive gap, right? And cumulative position is what? It is 10 over here. And let's say from 2 to 7 days, it is like 400 and 500 and minus 100, negative gap is there, and cumulative position is like 90 here. It is like minus 90 now. So that's a cumulative position. Okay. And also we have to do the scenario based analysis, like under the different scenarios, like I told you about the general scenario, normal scenario, or it could be a market issue, or it could be a bank specific crisis, right? That based upon that. So we have to measure the liquidity over the chosen time frame. Further, it's related to assumptions which are used in determining the cash flows. So we have to do the different assumptions. Those assumptions could be realistic. Those could be based upon the historical events. Those could be based upon the changing marketing scenarios, or those are also to be reviewed regularly, right? And there is category of the assumptions. Like there's assumptions could be related to the assets, like asset related assumption to what? That when the loan repayments will be there, those are to be paid on time. Prepayments can be there related to investments, related to interest receipts, or these could be the liabilities related like assumptions, like deposit stability, like core deposits or volatile deposits, premature withdrawals can be there, borrowings can be there, or off balance sheet related activities, like if those are crystallizing, if the guarantees are crystallizing, if the potential cash flows is there under the derivatives or something. So that's related to different assumptions that we do take. That is related to the different assumption that we do take. Clear with it? Clear so far? The next, it is about the Reserve Bank of India guidelines for the maturity buckets. The Reserve Bank of India guidelines for the maturity buckets. Now, RBI basically prescribes a time bucket based on the structural liquidity statement. We say it to be SLS. Based upon the structural liquidity statement, the RBI prescribes a time bucket, right? Under the flow approach, under the gap method that is being done, right? And for the standard maturity bucket classification is there related to it. And all the assets, liabilities, including the off-balance sheet items, these are classified into 10 time buckets. There are the 10 time buckets, and the assets and liabilities are classified based upon that. Like the bucket number one is like next day, or we can say 1 day, 2 to 7 days, 8 to 14, 15 to 28, 20, 50, 80, 8 to 14 days, and then 15 to 30 days, right? And further over 1 month, over 1 month to 2 months, and further 2 months to 3 months, 2 to 3 months. These are some, there are some updations, and 3 to 6 months, and let's say 6 months to 1 year, and 1 year to 3 years, and 3 to 5 years, and the 11th one is related to above 5 years, right? That's the case. So these are the updated buckets we are talking about. So it's like 1 day, 2 to 7 days, 8 to 14, 15 to 30, 1 to 2 months, like above 1 month to 2 months, and for the above 2 months to 3 months, above 3 months to 6 months, above 6 months to 1 year, above 1 year to 3 years, and above 3 years to 5 years, and greater than 5 years. Now the Time bucket over 5 years or above 5 years, that's basically related to very long term liquidity. And 2 to 7 days is basically the very short term liquidity. And 1 day is basically the immediate liquidity requirement. This is very critical bucket. This bucket is very critical bucket. And there is regulatory limit on the negative mismatches also. There is regulatory limit for negative mismatch. What is this regulatory limit? That as per the for the day one, we are talking about first of all, like this should be as per the internal policy. The negative mismatch must be allowed as per the internal policy here. Very much important. This topic is very important. And for the 2 to 7 days period, it should be lesser than the mismatch we are talking about, negative mismatch we are talking about. It should be lesser than or equal to 10% for this bucket. For 8 to 14 days, this should be again lesser than equal to 10%. And for 15 to 30 days, it should be lesser than or equal to 20%. Clear with it? So this thing is to be taken care of. This is quite important, right? So I'll be updating this particular part in the file also, do not worry. But this is the latest update about it. Okay. So I hope that you must have understood the concepts. And if you want the complete PDF related to it, just simply do WhatsApp me writing the CAIIB and WhatsApp it to the number 83609 I'll be sharing all the details with you. So that will be all. Thank you so much and see you again in the next video.